This is the Financial Thought Exchange podcast, where you get to learn from the leading thinkers in finance. I'm your host, Lara Moberg, and my guest today is Rob Arnott, who is partner and chair of the board of Research Affiliates, a company he founded in 2002, and which is a research-intensive asset management firm. Rob is also a co-portfolio manager on multiple funds at PIMCO, and he's a prolific contributor to the community of financial research. He's very good at challenging the conventional wisdom, so giving us a lot of new ideas and new things to think about, including what we're talking about today. And he is a pioneer of fundamental indexing, I shall mention, because we want to get into that today and understand how that fits into the conversation. This is the second out of two conversations. So if you haven't heard the first one, make sure to click on that. If you're on YouTube or any other channel, you should see that as well under the subscription for the Financial Thought Exchange podcast. And I should also mention that Rob is here also as the author of a piece for the CFA Institute Research Foundation called The Active Side of Indexing, co-authored with Lilian Wu, which is a terrific piece that was very eye-opening for me. So I recommend all of you check it out. Thank you so much for joining us, Rob.
It's a real privilege. Thanks for the invitation.
Now, I want to get into how you actually start looking at indices, and our prior conversation covered what is a little bit of the weaknesses of indices and how you actually underperform if you're an index investor, if you're a fund investor, because you tend to buy stocks that go up in price. Now, as you also mentioned, there's no real benchmark to the benchmark, because the benchmark is the benchmark itself. But you create a benchmark. You call this the True Cap 500. I dare to call it a benchmark, a comparison. A true cap 500 index. Now that sounds exactly what the S&P already is. It's the 5 largest companies by market cap, right? What is the difference here, and how is this used as a tool?
Yeah, well, firstly, we want to be respectful of S&P's intellectual property. So we do look at S&P's returns in the research we do. But the membership of the S&P is their own IP. And so we decided, people think the S&P 500 is the 500 largest market cap stocks. It's not. As I said in the last session, on average, there's 120 stocks in the S&P that don't make the cut as 500 largest. And there's 120 stocks that are in the 500 largest that don't make the cut for S&P. So you've got 75% overlap by names and about 95% overlap by weight. They're down at the bottom of the list. They aren't big. So you have 95% overlap. But there is that 5% difference, which is interesting. When we wrote this paper, we had a section of it that I'm particularly pleased with called Membership Has Its Privileges, which looks at the gap between members and non-members. And what we do find is that the characteristics of the non-members differ more and more from what the differences used to be. And the performance differs more and more, and the relative valuations differ more and more. So what we've seen is that over the last dozen years, the top 500 by market cap has outperformed the next 500 by several thousand basis points, but has done so in large measure by doubling its valuation multiple. Price to cash flow ratios for the top 500 have doubled relative to the next 500. Does that mean that the next 500 are doomed to have horrible growth? Well, that's what the valuation would be telling you, because that would be a fair value difference only if there was a huge difference in growth rates. The difference in growth rates for the last quarter century has been relentlessly the opposite direction. The second 500 has had faster growth than the top 500. So this is where it gets kind of interesting. Sharpe's arithmetic of active management suggests that because index funds track the market, you take them out of the market and you're left with the same portfolio. And as we discussed last time, it's not quite true. The S&P doesn't own all investable assets. CAPM would, capital asset pricing model would presume that the market portfolio is everything that's investable, all stocks, all bonds, and perhaps even all human capital on the planet. And the S&P owns a modest fraction of that. But even of the US stock market, it only owns about 80%. And index funds own at least 1/4 of those stocks by total market value. So when an index adds a stock or drops a stock, it's a big deal. Now, the section membership has its privileges. Firstly, apologies to American Express for swiping your famous tagline. Here I'm referring to membership in the main indexes. Membership has its privileges in two ways. First, the relative valuation goes up when a stock is added, down when a stock is dropped. There's a material gap there. And every dollar that comes into the index funds, pushes this gap wider and wider and wider. So it's now nearly twice as wide, the gap between S&P 500 or top 500 and the next 500. The valuation gap, as I said, has roughly doubled in the last dozen years, the relative price to cash flow, which is huge. That's a big privilege of being a member. It's even about 30% wider, that valuation gap, than it was at the top of the dot-com bubble. Yikes. Is it deserved? Are the Magnificent Seven plus the upcoming jumbo IPOs? But the bottom line is, as these get added to the index, does that create upward buying pressure because all of a sudden S&P indexers have to buy 25% of the total float of SpaceX, of Anthropic, of OpenAI, and so forth? And NASDAQ, which is looking to fast track membership for these IPOs, will have to own, I think the number is 8 or 9% of the total float of each of these companies. So if SpaceX releases $80 billion of float in the IPO, then S&P eventually has to buy 20 billion of that. NASDAQ has to buy another 5 or 6 billion of that. These are big numbers. Now, when you add a stock to an index, the index funds have to buy it. They are valuation indifferent buyers. They have to buy it at whatever is the market clearing price. Imagine they were trying to cap weight SpaceX. Speculatively, it's expected to raise 1.7 trillion, give or take, and 25% of that's $400 billion, but they're only releasing $80 billion of stock. So S&P indexers put in a bid to buy $400 billion worth of stock when there's only 80 billion available. The market clearing price for that is, if I'm doing my math right, it's infinity. Now, of course, they don't do that. They float weight. They don't market value weight. And that's the saving grace. But still, it's a big buy. And anticipation of that big buy is part of the narrative for why you got to buy this IPO now. The privilege of membership, future membership, means a potential big rise in value for the stocks. So this is much talked about as we speak. Membership has huge privileges. Our top 500 is not intended as a strategy. It is not better than the S&P 500. It's intended as a simple measure where we can do a deep dive into the names and the profits and so forth without interfering with S&P's intellectual property.
We should plug, by the way, as we talk about this, your recent opinion piece in the Financial Times that covers some of this, right? I think you touched on the.
That was fun. I had breakfast on the Monday with one of the editors, and he said, "Why don't you write this up as an op-ed?" Sure, why not? And it published the following Monday. So that was great fun. But it talks about the arithmetic. If there's 80 billion afloat, index funds between S&P, Russell, and NASDAQ, just those three alone have to buy 30 billion of the 80 billion. And if there's jumbo institutions with separately managed index fund accounts, that might be another 10 billion. I don't know. I don't know what that latter number is. But interestingly, when an index fund buys, it has to buy from a willing seller. Okay, that's a given. When an IPO happens, the people who buy usually are not buying with an intent to flip it at a short-term profit. usually they're buying it because they adore Elon Musk or they adore the company's prospects, its vision, and they don't want to sell unless they get a big premium. So you have valuation indifferent buyers, and the pool of owners has self-selected to be only people who adore the company. Think about that for a second. For most companies, there's a lot of people who adore the company, a lot of people who've been with the company, with that investment for years, and they really don't care, and a lot of people who are unhappy and thinking of dumping it. And so index fund comes along and says, I want 25% of the float. Okay, we'll do that. We want 10% extra. So the price goes up 10, the market clears. You get 80 billion of owners who don't want to sell. The pop could be huge, possibly entirely offset by the fact that the IPO price is going to be a huge multiple of revenues. It's going to be somewhere.
Which those levers of Elon Musk and the like
right.
They pay pretty high. They could end up paying.
Right. So you're paying for hope. Will skeptics who say this is too expensive offset the flood of people who say, oh, this is a great idea by a great man? And I'm not disputing the fact that Elon Musk is a visionary. He's also a phenomenal salesman, salesman for his vision and hence for his companies. But this whole paper that we're talking about is focused on the niche areas, the attributes of indexes that are largely missed. The active side of indexing is very real. It may be that an index in any given year is 95% passive, oblivious to relative valuations, oblivious to good or bad news, doesn't care, just along for the ride. But the 5% active component is very active, and it's on that margin where you can make a difference. I'm hoping the paper persuades some of the big index providers to think long and hard about whether to revisit how they choose what stocks to add and drop.
And would your suggestion there be that it should be more just market cap or price, maybe we should say based, as opposed to all these other factors that they're putting in there?
Actually, the fun factoid here is the True Cap 500 over the last 35 years beat the S&P by 3 basis points. Just a tiny, tiny margin.
That's not much,
about equal to the fee of VU. Okay, not much, but with 10 basis points higher risk and 1% tracking error, which would cause S&P aficionados to say, see, it's not an index. Yeah, it is. It's just a different construction. It's 99.9% correlation. But that 3 basis points comes at a cost of higher risk. So if you do a Fama-French attribution, you find that the True Cap 500 lags by 3 basis points. If you do Fama-French Carhart, including the momentum factor, the top 500 is even more momentum chasing than S&P. And as a consequence, its annual alpha is 5 basis points per annum below the S&P. So you have a higher return, but lower risk-adjusted return and more turnover, average of 5% turnover instead of 4. So I would not say True Cap is a better index. It's not. It's a different index. It's in some ways a purer manifestation of the top 500 than the S&P 500 is. But like I said earlier in the last call, I don't fault the S&P committee. They're doing their best to avoid black eyes associated with speculative come and go companies, and they've done an okay job of that. The other element is that the cash flow growth of the top 500, the True Cap 500, has been about, I don't have the exact number at my fingertips, but something on the order of 5 to 10 basis points per annum slower growth. So they do have the S&P. Yeah. So the S&P has done a nice job at the margins in terms of fine-tuning what 500 should be in the index. But basically, their decision rule is, if it's in the top 500 by market cap, we probably ought to seriously consider adding it. If it's not, we should probably seriously consider dropping it. That's a big part of their decision process. And that, I think, is a wrong-headed part of the decision process, because as we found in our research, you can do any of a lot of things and have a better cap-weighted index.
And so before we get into that, I just first one clarification, like you're saying market cap, but it's market cap of the float. So it's not actually a little bit of
Correct.
misnomer to call it the size of the company. It's sometimes the float is only a piece of the actual company.
And
So that's
the market cap isn't the size of the company. It's the size of the stock.
yes,
The
yes.
company,
Fundamentals, remember. Yeah.
yeah,
And another thing you mentioned too that we should clarify is you said that the top 500, the S&P, when you're in the index, you have slower growth. Now that you didn't need the price, you mean fundamentals
I
growth,
meant I
earnings,
meant the
and
fundamentals were growing slower for the
exactly.
top 500 and for the S&P 500 than for the next
Yeah,
500. And yet
yeah,
the
yeah.
next 500 is priced at about a 40% discount. Top 500 is an 80% premium multiple. So if you're able to buy faster growth, 3-4% per annum faster growth for 40% discount in valuation, well, then your internal rate of return is bound to be much higher by owning the second 500 than the first 500. So this is a simple truism that has been getting zero attention, and we're shining a spotlight on it because we think people should talk about it, and it's fun to explore what the implications are.
Yeah, and just to stay on the good case study here with SpaceX, isn't the analysis very different? So often, like in your study, there are companies, they're all public, and then they increase in price and fundamentals, and then they enter the index. Now we have these companies that go public and then automatically, like immediately, obviously are big enough to be in the index.
Mhm.
Does that somehow negate some of the problems that you point out with indices because they're not going to be flip flops and they just kind of enter there in the middle? Is that more neutral way to enter the index in a way?
Why do you say they're not going to be flip-flops?
Just because they're so large, like it's not marginally included. It's like by a big margin included. Like you can be flip flop, but then
Lucent was
you have to
the
fall more to be flip flop in this
Yeah,
case.
Lucent was the fourth most valuable company on the planet in early 2000. It didn't exist 5 years later. So when you say it can't be a flip-flop, no, I beg to differ. No matter how big it is, if they screw up badly enough, or if the market's perceptions of their potential growth is wrong enough, they can be a flip-flop no matter how big they are. So NVIDIA, largest market cap company in the world,
Mm.
what happens if hypothetically Intel is the first to come up with a chip based on quantum physics? All right. Something that can work 100 times faster. And oh, they've got patents. It's just a hypothetical example. Then you could see NVIDIA cease to exist in 5 years. I think the odds of that are extremely remote. But I
Mhm.
also think the odds of them having a 60% profit margin 5 years from now are remote.
Mhm.
Competition leads to mean reversion in valuation multiples, in profitability, in lots of things.
So you wouldn't say that the analysis changes a lot just because a company comes in at that like IPO and therefore gets included. It's not very different, like the reasoning around.
This is a new experiment. We've never
Mm,
had IPOs.
right.
NVIDIA IPO'd at a market value somewhere in the 1% range of where it is now. During the dot-com bubble, there were hundreds of IPOs. There were
Mm,
only 20 or 30 of them in the billion-dollar range. That's not huge numbers during an IPO binge. And slowly but surely, we saw bigger and bigger IPOs. The largest ever was Saudi Aramco in 2019, 29 billion raised out of 1.9 trillion of market cap. So they released 1.5% of the share and said the public can own this, and the public can price it how
yeah.
they want to price it. Of course, the sheikh in charge of Saudi Arabia will probably step in and make sure the price doesn't crater or soar. And so, anyway, these IPOs, the AI IPOs, are testing new ground. The notion of an IPO that comes out with a market value of over 1% of the entire US stock market is brand new territory.
Mhm.
It'd be like Tesla waiting until 2020 to do their first IPO, rather than slowly but surely earning their way into the market. and doing so with business success and an ability to build good cars.
So everybody's wanting to know now, how can I be a smarter index investor then? If we start by this notion of, can I avoid this flip-flopping? Can I avoid investing in those? It's so one of the things that you write about, right, is that, well, what if you wait a little bit until it seems more likely that not going to just keep flip-flopping there, you incur the trading cost. I think that the main, for me, my perspective, certainly, objection to that would be, well, now you're waiting even more to maybe the price keeps going up and now I really missed out more and more, and I keep buying even higher prices and selling at even lower prices. Or how to think about that.
Yeah. I wrote a paper back, I think in 2013, called Rip Van Winkle Indexes and Upside Down Strategies. The hypothesis was, you're Rip Van Winkle. You go to sleep for 1 year, 2 years, 5 years, 10 years, 20 years. And when you wake up, whether it's after 1 year or after 20 years, all you know is what was in the index when you went to sleep. So you figure, okay, I want to buy that portfolio with the weights that existed back then. Well, lo and behold, you add scores of basis points if you use not the 1 year old index, because that has a momentum component, but the 5 year, 10 year, 20-year-old index. You're buying stocks that may have been frothy and expensive then and aren't anymore, are sensibly priced relative to fundamentals. You're buying stocks that survived, so the survivorship bias kicks in, and the good old Rip Van Winkle slept for 20 years. If you buy the 20-year-old S&P 500, you wind up with, I think the number was 160 basis points per annum higher return if you own it proportional to its weights back then. And so if you just buy that portfolio with the weights that prevailed back then and buy it today, you wind up with 160 basis points higher return. What have you done? What added the money? You added value because you're no longer linking the weight to the price. The fundamental insights of fundamental index are tying the weight to the price is dangerous because the more expensive the stock is relative to its fundamentals, the bigger your investment is. And why would you want to put more of your money in a stock just because it's expensive? The other insight is fundamental selection. You don't choose to own companies because of their market cap. You choose to own companies because of the fundamental size of the business. And so fundamental selection and fundamental weighting is RAFI, fundamental index. Fundamental selection and cap weighting is RACWI, Research Affiliates Cap Weighted Index, which
so
simply...
Can you say those acronyms slowly again and what they stand for?
Sure.
So
RAFI, Research Affiliates Fundamental Index, and RACWI, Research Affiliates Cap Weighted Index. RACWI, all it does is say, I don't want to play the game of adding a stock just because it soared. I want to add a stock because the underlying fundamentals have validated that price move. The underlying fundamentals have grown big enough to matter. That means that I'm going to be adding NVIDIA or Tesla probably 2, 3, 5 years after a cap-weighted index does, but not necessarily at a higher price, because it came onto the cap-weighted index in part because it soared and is trading at a premium multiple. It might not be trading at quite as much of a premium multiple anymore. So fundamental selection means the stocks you're adding, instead of being priced at twice the market multiple, are priced at a modest premium, maybe 20%. The stocks you're dropping, instead of being half the market multiple, there are companies that have faltered as a business and come out of the index because they faltered as a business. So they are probably at a discount, but typically more like 20%, not 50% off. So you're not buying froth and selling deeply out of favor. You're buying companies that have shown fundamental growth enough to validate whatever price action has already occurred. And you're selling stocks where the fundamental disappointments probably already happened in the price, but you're selling when it's really, as a business, no longer big enough to matter. So what it does is it slows down the turnover. Your turnover for a true cap is 5% per annum. S&P slows that down to 4% per annum by subjectively deciding which companies are too frothy to think about adding. And RACWI, Research Affiliates Cap Weighted Index, is turnover once again goes back down to 4 because you're slowing down the process. And your flip-flops aren't hurting you as much. So what we find is that over 35 years, S&P return 10.6, top true cap 500, 3 basis points better. Suppose you do it by fundamental size, now you've got 40 basis points better.
Mm-hmm.
That's pretty cool. There's other ways to slow down the process. Apropos of our paper, Rip Van Winkle indexing, instead of using the 5-year-old or 10-year-old or 20-year-old index, which will include stocks that don't exist anymore, so you have to leave those out. It'll exclude any stock that was launched in the last 20 years or that wasn't in the index 20 years ago. So you're going to have big exclusions. Why don't we slow down the process a little bit less by just buying the companies that are in the top 500 by 5-year average market cap? So that means that SpaceX, you're going to have to wait 5 years. And if
so no fundamentals involved now. We're just doing market cap.
This is back to just pure market cap, but just pure market cap with that little bit of filtering to say we need the 5-year average market cap to be among the 500 largest. You're adding 10 basis points. Here's another interesting thing. If you take the top 500 by market cap, just the current market cap, and introduce what we call banding and seasoning. Banding means it has to get into the top 450 before you consider adding it. It has to get outside of the top 550, so a 20% range. Out of the top 550 before you're going to kick it out. All right, well, that's slowing down the process. And if you do that and require it to validate that transaction by hitting that threshold twice in a row, so 1 year of seasoning, it has to be in the top 450 2 years in a row. Has to be outside of the top 550 2 years in a row. You just added another 10 basis points. If you take 5-year average market cap and you do the same banding and seasoning, you add 10 basis points to that. So these are easy ways to make 5 basis points, 10 basis points, 15 basis points incremental return. These are perfectly legal, sensible ways to just slow the process down, and the turnover goes down 20%. It's very cool. The one strategy that's not helped with banding and seasoning is choosing the top 500 by fundamental size, because you're already slowing down the process quite enough, thank you.
The banding part is probably the most counterintuitive, because it sounds like now you're really instituting that you're buying high and selling low, even lower. Before it was here, and now it's like even bigger gap.
But think of it this way. If you have a stock that goes from rank 501 to 499 to 501, you just bought it and sold it.
Yep.
Ouch.
So you're avoiding that.
Yeah, you're avoiding that. You're slowing the process down. And the seasoning means if it soars up into the top 450, you wait a year and you aren't buying it when the momentum is stretched. You're buying it after it's seasoned for a year. Just as an example, I would be ecstatic if existing index providers said, you know, Arnott's research shows we can add 10 basis points just by banding and seasoning. He didn't patent that idea. Let's just do it. Please do. You're going to make your customers 10 basis points richer per annum for the next 20, 30 years. They'll be 2-3% better off than they would have been. And it's so cool.
Because it's difficult to do as an individual investor, right? It's like I hold the S&P in this index fund, and should I be trading the small companies and negate this flip-flopping? It's difficult, right? It's very impractical as a private person to do. Yeah.
Exactly.
So there's no like short ways that you would recommend our listeners if they are trading their own money.
RACWI does have an ETF now. I won't go into further detail because it's wrong to promote a brilliant idea.
So we do want to emphasize the fundamental indexing. Just get a sense a little bit more on what it means. What do we mean by fundamentals? And I guess what the big question becomes, like, are we even talking about indexing anymore? A lot of people will say, now you're doing a smart beta. Of course, that's going to outperform, because I know that smart strategies outperform, right? Like, why isn't that what you're doing? You're doing factor investing now. What are we talking about here?
So here's a fun fact. The fundamentally selected cap weighted index, which we would call a RACWI 500, has 0.7% tracking error relative to S&P. The TrueCap 500 has 1% tracking error. And nobody would say the TrueCap 500 isn't passive. You're just saying, whatever's the 500 largest market cap stocks, I want to own them. And the list changes from year to year. So I'll rejigger it once a year.
Right.
You get your 5% turnover, your 95% passive, 5% active. And yeah, it's performance chasing, buy high, sell low, but it's an index fund. The other says we're going to choose companies based on their fundamental size. 500 biggest businesses, we're going to cap weight. As of today, the active share of that relative to the S&P 500 is 5%. There's 95% overlap. There's 5% of the S&P, starting with Palantir and AppLovin and CrowdStrike and DoorDash, that aren't big enough businesses. We don't include them. There's 2% of RACWI, including companies like Cheniere Energy, the biggest producer in the United States of LNG, but it doesn't make the S&P because it's too small cap. The business is 5 times the size of Palantir's business. So big business, small cap. They comprise, because they're small cap, they comprise 2% of RACWI. Why 2% here and 5% here? Because we then have to overweight the overlap stocks by 3%. If NVIDIA is 7% of S&P, it'll be 7.1 in our index. And so the overlap's 95%. The decision rule is entirely objective. And the tracking error with the S&P is smaller than the tracking error of the TrueCap 500 with the S&P. And nobody would say TrueCap isn't passive. Why is our tracking error smaller? Because the S&P committee is filtering out some of the frothy names that we filter out through an objective rule. Very, very interesting.
Right.
The committee
so they're
is
already doing fundamental indexing to some extent, but not in a very
in a
transparent,
very modest, limited, and carefully controlled way, yes. So is S&P 500 passive? Heavens no. It's just pretty darn close to passive. Do you want to say that if it's not market cap selection, it's not passive? Fine, then we're almost perfectly passive, but not quite. We argue that if an index has 5% turnover, it's 95% passive, 5% active. The turnover inherently is active.
I would think that like what people would want to understand is like the big difference this makes, right, between the market cap and the fundamental indexing, like when you do that.
Well, fundamental index uses fundamental selection, how big is the business, and then fundamental weighting. We'll weight the company proportional to the size of the business. If the business is big, we don't care if it's large cap, mid cap, or small cap. The weight's going to be the weight. It's weight in the economy. So I look at index funds as seeking, studiously trying to mirror the look and composition of the stock market, and fundamental index studiously seeking to mirror the look and composition of the publicly traded macroeconomy. Economy weighted versus market value weighted. That's the essence of fundamental index. Now, fundamental index takes the growth stocks trading at premium multiples and says, we'll reweight you down to the fundamental size of your business. Value stocks trading at deep discounts will reweight you up. So we're saying, yeah, I get it. Company's great. I'm sure you're right. And because you're right, it won't hurt me to hold less because it's already in the price. And the bad news on these guys is already in the price. So it won't hurt me to hold a little more. But if the market gets it wrong and some of these companies don't deserve their premium, then trimming it will have been useful. More to the point, we talked about mean reversion. If a stock soars and its fundamentals don't, we're going to say, thanks for the gain. I'm trimming it. If it tanks and the fundamentals don't falter, we're going to say, thanks for the deep discount. I'm topping it up. So you get a rebalancing alpha. You have a value tilt that's every bit as much as the cap-weighted value indexes. With that value tilt, you're getting a rebalancing alpha that's missing from the value indexes. So when you compare RAFI, the fundamental index, with conventional cap-weighted value indexes, you find a fair amount of overlap, a pretty darn high correlation. And because of the rebalancing alpha, RAFI wins roughly 7 out of every 10 years, all over the world. Well, that's pretty cool. That also implies a long short opportunity, which I think is kind of fun to think about. RACWI wins a like percentage of the time, but with much skinnier margins, because instead of weighting companies by fundamentals, we say, we'll choose whether you're in the index based on your fundamental size, but then we're going to cap weight it, or I should say float weight it. And if you're float weighting it, you're tracking the market. You have an index fund. And the live correlation of RACWI with the S&P 500 on a total return basis has been 99.96% correlation. That's pretty darn high.
So I guess all of this gets to this question of, hey, I just want to be passive. Like everything just seems so active. How can I be, what is theoretically or, philosophically the only way that we can be passive investors in this world? I don't know if you're thinking about fundamental index and being more passive because you're really getting to the actual economics of it. But there too, you're going to have to choose your weights, right? Is it earnings? Is it cash flows? Is it the sales that you're using? And it's like we're leaving ourselves in this world of there is no alternative in terms of I have to be active no matter what I do here.
The broad indexes like Russell 3000 and other indexes that seek to span the whole stock market are one way to capture Sharpe's arithmetic of active management. But keep in mind, Sharpe's arithmetic of active management says that in aggregate, active managers can't win. It doesn't say that individual active managers can't win. And so one way for retail investors to play the research I'm talking about is a little difficult. I mean, there's ETFs on fundamental index, lots of them. There's one ETF on RACWI, tiny, but it's there. The way retail investors can play this is simply ask the question, when S&P adds a stock, is it a big business or is it just a frothy multiple? And when it drops a stock, ask the question, is it a little business or is it just trading at a deep discount? If it's just trading at a deep discount, fine, own your S&P 500 index fund and buy a little bit of the stocks that are out of it, the stocks that have been nixed. The paper we wrote, Nix the Upside of Getting Dumped, we start with the analogy that most of our readers have sometime in their life been dumped, and they could choose to take away a few lessons to use them in their future relationships, or they could wallow in self-pity for life. A company can wallow in self-pity for life and drift on to oblivion, or it can say, there are lessons to be learned here. How can we do better? And some do, but they're all priced as if they won't. That's the beauty of filling in the gaps. Until some of these ideas make their way into mainstream indexes, this work is more theoretical, yes, practical, yes, usable by the retail community, not so much. Usable by the institutional community, you bet.
Right, where the institutional community and certainly the index providers, right, could be clearer and more consistent in their fundamental methodology here.
Yeah, and one of the things that's been brought to the fore by the SpaceX IPO is the whole notion of changing the rules. NASDAQ changed the rule. They introduced a notion that we'll wait till 15 days after the IPO and we won't buy more, we'll market cap weight the company, but not more than 3 times the float weight. Okay, well, that's a set of subjective decisions, and the underlying true subjective decision is our rules won't allow us to buy this stock. We want to buy this stock. Let's make it happen. S&P.
Sounds pretty active.
Right. I mean, NASDAQ is not an index fund. It doesn't span the market. It's not passive. It's an active set of decisions in the form of decision rules. S&P could have said, we have our rules. We'll look at it when we can look at it. Instead, they said, we're going to study our rules and think about it. And then they decided we're not going to change our rules. Firstly, kudos. Thank you for not changing your rules. I think that's the right decision. Secondly, it became an active decision because you were thinking of not doing it and you decided to stay with your rules. So what seems like a passive decision, we're sticking to our rules, is actually an active decision because you were thinking about not sticking with your
Right.
rules.
Another thing I can't help but thinking about also when we have this kind of forced buying by people wanting to be passive investors is how this creates a momentum in stocks in the aggregate. Is it fair to say that people who are momentum traders, they might actually be right, that there is a valid argument to make that momentum works, and it's because it's driven by these index rules, price go up and more people have to buy a stock, so you get more momentum in the
Yep.
market.
That argument doesn't work for a very simple
Okay.
reason. There's very few index additions and deletions each year, and people say momentum works across the board. So if S&P adds or drops 10 or 20 companies in a year, that's it. And people say momentum works, but hey, not all the stocks that doubled in the last year are suddenly being added to the index. So it's not accurate to draw that conclusion. Furthermore, momentum has a very iffy record. It has worked. Momentum works beautifully until it fails. When it fails miserably. 2007, 2008, momentum worked very, very nicely. And then it had its worst year ever in 2009. A long short momentum strategy, long high performing, short poor performing stocks would have had a minus 40% return that year in a year when stocks were up 26%. If the market's up 26% and you're down 40%, I would say you had a bit of a disappointing year. That said, your comment about coming into the S&P, perhaps creating added momentum for the index and for the market is, I think, accurate, because here I'll get a little controversial. The evidence is that the economy is a bit of a K-shaped economy. The median American is struggling. It's not a recession yet, but they're struggling. And the affluent are doing just fine, thank you. Who owns stocks? Mostly the affluent. And if the affluent are doing fine, they have more money to put into the market. Where are they going to put it? Gold? Not likely. Bonds? Not so much at these yields. Stocks? Sure. IPO for Musk's latest and greatest? Sure, why not? It's this kind of thinking that can drive markets higher. So I think we have not a momentum fueled market, but a liquidity fueled market. And that can come to an end fairly abruptly. The market is, by many measures, at stretched multiples. I've been called a perma bear. I'm not a bear on things that are cheap, and there's a lot of stuff that's cheap right now. The valuation gap between large cap growth and small cap value is about 5 or 6 to 1. That's historic extremes. So when the dot-com bubble unraveled, in the first 2 years after, from March of 2000 to March of 2002, NASDAQ was down 50%. Russell 2000 value was up 53%. If you pivoted into small cap value at the turn, which obviously is very difficult to time, but if you did, you were 3 times as wealthy as the NASDAQ investor in just 2 years. Could the same thing happen now? It's not impossible. I wouldn't predict that, but I would say on a 10-year look-ahead basis, you're way more likely to earn 10% in small cap value than you are to earn 5% in large cap growth.
No, thank you so much. Yeah, the lesson is, things can pivot pretty quickly, and understand your environment. And I certainly hope that our listeners here have gotten a realistic and perhaps a less romantic view on the markets, as well as what indices actually mean. So thank you so much for being with us today. Thank you so much, Rob.
It's a privilege. Thank you for inviting me.
And thanks everyone for listening into the Financial Thought Exchange podcast. This was the second out of 2 conversations. So if you haven't heard the first one, make sure to check that out on any channel that you're listening to our podcast. I've been your host, Lara Moberg. Our guest has been Rob Arnott. He is the partner and chair of the board of research affiliates, and he's the author of the Research Foundation Brief, The Active Side of Indexing, together with Lilian Wu. Thank you, and I'll see you next time.
For more information, please visit rpc.cfainstitute.com. www.arnott.org/research-foundation.